Hello everybody, Luke Gromen, FFTT. Hope you are well. Hope you had a great weekend. I know it was a beautiful one here in Cleveland, particularly after early Saturday. It got much nicer. So nice warm day yesterday and off to a good start so far this week. So with that, I'm going to jump right in. Thanks for being here. Thanks for the questions you submitted. I'm going to run through a number of them. So with that, first question is from David. What are your thoughts on the macro implications of this weekend's drama in Russia? I know it's a question a lot of people have been focused on. It was definitely something I was watching with great interest this weekend. My answer is that it's too soon to tell. I think we're going to know more in coming weeks, months, how it shakes out. To me, it's just too soon to tell. So as I like to say, let's watch. From Russell, what data set are you using to track the increase or decrease in liquidity? The one that is a broad construct, but it's Fed. It's a net liquidity metric, right? So it's the Fed's balance sheet minus the reverse repo balance minus the TGA balance. Then you consider whether oil's moving up or down. You consider whether the dollar's moving up or down. If oil's moving down, it adds to liquidity. If the dollar's moving down, it adds to liquidity. It's all that is my construct. I mean, I look at other assets as well, right? So you can look at what cross-currency basis are doing. You can look at what the DXY is doing, the dollar, the absolute level. You can look at Bitcoin. There's a number of things I kind of watch all together. It's not scientific, really. There are services. I know Michael Howell's Cross-Border Capital does a really nice job with measuring liquidity. He's been spending a lot of time in his career doing that. So, but those are the metrics that I use and watch. From SE, do you see that the global South's economic cycle will continue to diverge from the West's problems with debt, etc., and start to be increasingly discorrelated economically? In my view, not until the global South changes the monetary system to one that is multi-currency pricing of commodities with net settlement in gold, good settlement, net gold settlement, or net neutral reserve asset settlement. They're moving in that direction globally. That has bought some time in certain cases. You can see hints of this with yuan swap lines, where countries that are desperate for dollars move to yuan swap lines, trade in yuan, like Argentina's done with some commodities recently. They are obviously not doing that out of a position of strength, but it buys them dollar liquidity time. But they're still tied to the dollar system ultimately. So unless they make a clean break to a fully functioning multi-currency commodity pricing with a neutral reserve asset, like I said, net gold settlement, their fortunes are still inextricably linked to the dollar system. So I don't think they can separate yet until they do that. From Rex, you like energy. How do you prefer to get energy exposure? By holding the underlying commodity, buying oil stocks, buying green energy stocks? My biggest exposure on energy personally is a electrical infrastructure equipment maker. It's via a private equity investment that I'm involved with. It is generation agnostic. In other words, the equipment works if it's coming from nuke, if it's coming from coal, if it's coming from gas, coming from hydro. It doesn't matter how the power is generated. It works. To me, it's almost, I think it's a, I always think of it as when you have a gold rush, or when the stories about when there was the gold rush out in California. Some of the gold miners got rich, most of them went broke, but the guys who really did well were the guys who sold picks and shovels. And so this is I like to invest in people making picks and shovels in booms. So this is a pick and shovel maker in what I think is going to be a very attractive industry, electrical infrastructure, over the next probably 10 years plus, given what we're seeing for a number of different reasons. I also own a little bit of copper equities. I own some electrical vehicle metals, ETFs. Those are small in both cases, some oil services. For me, gold and Bitcoin are chicken plays on energy as well. If you look over a long period of time, gold trades within a range versus energy. Gold is a derivative play of energy. It takes energy to mine gold. It takes energy to mine Bitcoin. And so both of those to me are chicken energy plays, not just from the embedded energy, but also with the more expensive that oil and energy gets, the more pressure that puts on global bond markets, the more pressure that puts on global sovereign debt markets, the more pressure that puts on central banks and pushes them toward some version of more balance sheet expansion, yield curve control, which is good for gold and Bitcoin. So I consider those sort of derivative energy plays, gold and Bitcoin. From Jim, who will win? Will OPEC boost oil price, or will recession and Western countermeasures reduce demand and cause prices to fall? I think oil's going higher. I actually think the U.S. is okay with Saudi's recent price cut. Production cut to try to keep prices up. And the reason I think that is if oil goes too low, U.S. shale is going to start going offline. And if you remember, we've said before, U.S. shale has been about 90% of global oil production growth over the last 10 years. And when it has a very steep decline rate. So if shale production basically just stops drilling, you're going to see a pretty sharp decline in U.S. shale production. On an annualized basis, it will actually fall more than global demand has ever fallen in a recession. So marginal supply will fall a lot faster than demand has ever fallen in globally in any recession. So to me, the supply-demand dynamic outlook for oil is really positive. And geopolitically, I think the U.S. is okay with prices here and not getting too high, but I don't think they want them much lower. And the reason I think that is, if shale rolls over, if prices get too low and shale rolls over, it's going to be very difficult to get shale back to new highs in terms of production without a very significant oil price spike, in which case you're going to basically be ceding the oil market to OPEC and Russia, which is not in the U.S.'s geopolitical interest. So I think the U.S. is okay with prices here. I don't think they want them much lower, and I think I think Saudi's actually really just being the adult in the room by cutting production. Let's see, from David, do you foresee capital controls coming soon for countries that are energy importers with negative balance of payments? If not, how will governments prevent flight out of their depreciating bonds and currencies? Yeah, I think you can see that. I mean, you can see energy importing nations with twin deficits are having problems everywhere, right? Turkey in particular. Argentina was historically another one. So the short answer is I think you'll see more of those metrics, attempts to defend currencies. Even the UK, right? Energy importer, twin deficits, big current account deficit. They are, in my view, the Bank of England is effectively raising rates more than expected last week. I think there's an element of sort of, yes, fight inflation. It's always fight inflation, but it's defend the currency is another way of saying that. So I think you'll possibly see those capital controls. I don't know when. I don't know where that will be. That's not very helpful, I know. I do think you've been seeing some measures of soft, I won't call them capital controls, but I'll say regulating buying of Western sovereign debt by virtue of banking regulations, right? So here in the U.S., I've picked on a lot because I'm most familiar with it, but they regulated banks into buying treasuries. They regulated money market funds into buying treasuries. They with the tax code change under Trump in 17 or 18, there was a beneficial tax treatment to corporate pensions buying more treasuries. So those aren't capital controls per se, but they're capital incentives, shall we say, capital regulations, right? To accomplish kind of the same thing with a velvet glove as opposed to the iron fist. So I don't think we're getting to the iron fist point. I do think these regulations will continue to intensify because the fiscal problems are only getting worse in the U.S. And elsewhere in certain places around the world. I do think the rate hikes, the aggressive rate hikes of the past 15 months have helped and bought time on that front. So that's how I'm thinking about looking at it. I don't have any concrete answers on. I do think it's possible. It's very dependent in terms of timing on events, right? If you have a steep economic correction, you might need those types of things more quickly than not. If you can kind of soft landing and muddle along, then maybe they can kind of keep all the plates in the air for even longer and not have to move to those types of activities. Multiple questions on what's the potential impact of the BlackRock Bitcoin ETF. I'm going to assume that we'll discuss this as if it gets approved. Probably another one that's a little too soon to tell, but I did have a couple thoughts. The first being that I think it's indicative of institutional demand continuing to improve for Bitcoin, which I think is a positive, all else equal. I did find it interesting that there is an apparent change of heart that Larry Fink had in terms of where his comments were a few years ago regarding Bitcoin and crypto more broadly relative to this Bitcoin ETF filing. I also think it's interesting. This is the second major, too big to fail U.S. financial institution getting involved with an ETF in an asset class that would be amongst the best performers if the Fed has to begin re-expanding their balance sheet or move to yield curve control at some point. In other words, you had BlackRock looking to get involved with Bitcoin, with the Bitcoin ETF filing. And as we've talked about in the past, JP Morgan, December of last year, became the second custodian of the GLD gold ETF, the biggest gold ETF in the world. After they became the second custodian alongside HSBC after the GLD had been in place for 18 years. So just 18 years after it was launched, JP Morgan decided it wanted to get involved. And then JP Morgan noted they might move some of the storage out of London to Zurich or elsewhere, perhaps to New York. So that is also of interest to me, that there seems to be some too big to fail U.S. institutions getting involved with assets that I think would be at the top of the list in terms of performance if the Fed had to begin regrowing its balance sheet into still elevated inflation. So those are the thoughts. Let's see how it develops. Those could change, but that's where I'm at the moment. From John, U.S. LNG export capacity will increase by 10 billion cubic feet per day, 2024-2025. Do you see continuing LNG and oil exports and SPR withdrawals as a component of the Fed's strategy to defend Treasury sales and support dollar liquidity? U.S. natural gas supply may not be adequate to fill 10 billion cubic feet per day demand. I thought that's a really good question. I agree 100% with your characterization of it, which is that U.S. energy exports and SPR rundowns last year are effectively energy swaps with allies that de facto defend the Treasury market. You think about this, otherwise, and we saw this last year in spades, particularly with Japan, high energy costs pushed Japan into a twin deficit situation. They had to sell dollar assets, treasuries, to raise dollars to import energy, because given the choice between having treasury bonds and savings or being short energy, they get rid of the treasury bonds and they address the energy shortage. They address the higher cost energy. So by virtue of the U.S. getting oil prices down or by supplying energy into that market, that is a de facto defense of the treasury markets. It's a oil swap with allies, however you want to define it. De facto, that's effectively what we're talking about here. I think it's also does tie in with the dollar, because ultimately, if the energy supply situation gets critical enough here too, allies will have to make a decision: go without energy or de-dollarize their energy imports, move to buying in their own currency and settling in goods and gold, as China and others are effectively doing. And I think that's again, it's a defense of the treasury market. It's a defense of the status quo system that de facto, if the U.S. is exporting oil and gas and running down the SPR to contain energy markets. So with that said, it basically imports the energy inflation, right? So by selling gas, if we didn't export that gas, all else equal, we would have a surplus of gas here. Gas would be cheaper, and we'd have more deflation here. If we're going to put that gas on the open market, the world market, that market is priced well above, last I checked, the U.S. domestic gas market. So all else equal, it is an inflationary impulse to the domestic market. Do I think it will continue? Yes, I do think the U.S. will continue to do that. particularly as the global south continues to de-dollarize their commodity markets led by Russia and China in the manner that I said, out of a matter of national security for them. And so I think we're just watching the U.S. use U.S. energy resources to de facto support treasury markets and to a lesser extent the dollar. From Chris, clearly the U.S. fiscal position is dire. Why do you think most of the macro world is avoiding that elephant in the room? Is it simply, does it make a lot of their analyses moot, or is there something else? I don't know. It's hard to speculate. I mean, in my view, if I'm going to speculate, I would say it's, a couple things. Number one, it's hard to see things that have never happened before, and this has not happened in the U.S. in anybody's lifetime, myself included. And so, that's part of the reason why so many people miss that U.S. home prices could fall nationally. No one thought that was possible. Very, very few people thought that was possible ahead of the great financial crisis, and it's why so many people miss the rub-off effects of home prices falling nationally. When it hasn't happened, it's one needs to have more imagination to see it. The other one kind of falls in line with Upton Sinclair's famous quote: "It's difficult to get a man to see something when his salary depends upon his not seeing it," which is to say, pointing out the U.S. fiscal situation in certain seats can be a career-limiting move. When you're at a big bank, making the bond desk angry with you is not a good idea. So, and sort of pointing out and harping on the fiscal situation of the U.S. Probably not going to make the Treasury bond desk or the government bond desk at big banks very happy. So I don't think that's the biggest part of it. I think that's a niche reason, but I do think the imagination side of it is the much bigger part of it. And then finally, last question from Fred. Explain why the U.S. can't solve its debt deficit problem by cutting spending and or raising taxes, because it'll send the economy into a recession and thus make debt to GDP worse. We're all Greece now. Yeah, that's exactly it. Is if you raise taxes, you take money out of the pocket of consumers. You drive a recession. If you have a recession, debt to GDP always rises in recession. Deficit as a percent of GDP always rises in recession. So you can only raise taxes to the point that you don't drive a recession. And in the meantime, even if you don't get all the way to a recession, anything that drives nominal GDP growth below the rate on the debt, with debt to GDP at 120%, with deficit at 8% of GDP, you go into a debt spiral. So you gotta keep nominal GDP growth above the rate on the debt, or you're done. And so in the same thing with cutting spending, U.S. government's 25% of GDP. So you cut government spending, you're going to cut GDP growth. Same dynamics. You can't do that without going into a debt spiral. So with that, I'm going to finish up for the night. As always, thank you very much for joining me. If you like these updates, you can check out FFTT Tree Rings, FFTT-LLC.com for more information about that. 10 most interesting things, brief synopsis on what grabbed our attention about them, and whether it's refuting or supporting a way of thinking we had previously had. Get a lot of great feedback on that, and you can also find out about what else we're up to. So with that, thank you for joining me, and I look forward to chat with you all soon. Take care, everybody.